There is a substantial risk of loss associated with trading forex, binary options, stocks, or equities, collectively, asset classes. Only risk capital should be used for trading. Trading in any asset classes is not appropriate for everyone. Past performance is not necessarily indicative of future results. No representation is being made that investors will make profits or will not sustain losses. Before trading in any asset classes, investors should consult with their professional broker, financial advisor, or financial consultant to determine whether trading asset classes is appropriate. Investors who trade in any asset classes should only do so if the capital used for this purpose represents funds that an investor can afford to lose without adversely impacting the investor's lifestyle. No trading strategy or methodology is without risk of loss. No trading strategy is risk-free, and no trading strategy can guarantee profits or freedom from losses. Investors risk losing the cost to execute any transaction, including associated commissions or fees. You should carefully consider whether trading in any asset class is appropriate for you in light of your investment experience and financial resources. Any trading decisions you make are solely your responsibility and at your own risk. None of the statements or materials in the Auvoria Prime chat rooms constitute a solicitation or recommendation to buy or sell.
Welcome, Auvorians, to the Saturday Thanksgiving Special Day Holiday broadcast. Today's the 26th of November, 2022. My name is Steve Federal. I am the CMA of Auvoria. I am one of six that help lead the organization. My particular role is in risk management. So I try to do these just a little bit after 10 a.m. on Saturday. This is Eastern time. We're down here in Florida. And then also on Tuesday around 1 p.m., which I did not do last week. So because of the holiday, this is going to be a short one. Of course, it seems like I say that every damn weekend, right? Let me just go to the charts. For those of you that, if you're looking at my screen here, you can see this is the playlist. So I try to do these every Saturday. They're up on YouTube. They're up on Vimeo. You can find the links at the bottom of the Auvoria website. Let's see if I can make this screen a little bit bigger. So, and they're right down here at the bottom if you haven't seen the whole things. So that's the Vimeo channel. That's this. This just takes you to the main channel, but we have these broken out in what's called playlists. Okay. But the reason I'm on this page right here is I wanted to solicit feedback from the audience on this. So we have, all these EA tools here. What I want to ask is that as we come into the end of the year, over the holidays, I'm actually going to be doing a little bit of a deeper dive and analysis on many of these AI bots. Some send out the signals, some are fully automated depending on where you are in the world. But what I would like to do is to see if I can get from the crowd, and I can give you my email address if you want, or you can hit me up on Telegram, either way. I want to get either some MyFX books or FX Blue links to live accounts that are running these. Now, a couple of criteria, if you would please, before you send me these. I do need, it has to be on a live account, it has to run more than 6 months. And it has to be an account where, I don't care if you're taking signals or the bot's trading for you, that doesn't really matter to me. What I do care is if you're executing other trades in that particular account that's being, audited, if you will, on those two websites, I can't use that link. Okay. So just 6 months in operation. I don't need variable. So I'm pretty good friends with Design. We get this one completely covered. But I do want ones for other ones. Okay. So these can be the developers. This can be from, any team leader. It could be from any subscriber. I'm not really concerned about where it comes from. I just want to put together a broad list. And the point is, and I know this has been diced up 6 ways to Sunday, but I'm going to sort of handle this the federal way that I see it. I'm going to be taking a hard look at all of these EAs. So from almost like a white paper research standpoint. So we've got some pretty significant capital to deploy at First Down coming up from a whole bunch of money that's come in the doors. And I want to put some of it to work in a very small allocation, depending on the client. But for most clients, I want some diversification into the Forex or U.S. indices spot, essentially just MT4 traded diversification. This is probably going to comprise at the most, maybe 3 to 5% of the client's equity-based portfolio. This is risk-only assets for the client. So our allocations that we're looking to put together, essentially, we're just looking for, and we've begun almost like a broad search in the alts space, right? That's what this is. This is the alternative investment space, just like hedge funds, venture capital, and private equity. We have sort of put out the feelers for an emerging market category, right? And many of these are emerging managers as well. So I've got a couple on the list that I follow. I want to follow more. It's not necessarily important anything else other than I need live accounts. I need it to be over 6 months, and you cannot have traded other stuff in the account, right? So we're just trading Flash, or you're trading, Gearbox, Neo, any of the tools like Panther. So send them to me. Here's my email. I'll leave this up in the screen. So it's sfederal@auvoriaprime.com. And I think that's it. Let's go into the news. One thing I've noticed, you can see we've moved for the next week. One thing I've noticed that something in Forex Factory has changed, and that is the specs, if you will, on a particular news event. So for those of you that are just getting an education on kind of all this news, and a lot of times, most people will be like, why do I care, right? So Forex Factory has a section called Why Do Traders Care, right? So in the case of Chairman Powell speaking next week, and I've talked ad nauseum about this, obviously, but speaking at an economic event, it tells you what the event is, and then what the usual effect is. But I thought this is good as Why Do Traders Care. I rarely read this deep into this stuff, but I sort of was just poking around Auvoria's website, some of the products, and I'm trying to expand out what I talk about it, because I pretty much covered everything in the last 2 years. I need new material of risk to cover, but essentially, central banks control short-term interest rates. They typically have the most influence over a nation's currency value. And I speak mostly in just developed markets, obviously. But, the speaking that any central bank, and it doesn't have to be Chairman Powell, it can be any of the 12 Fed regional governors. It could be, Bank of England, any other of the European banks, Japan, so forth, Canada. Anything down in Aussie land, anytime a central banker speaks, the vast majority of the time, I'm talking like 99, at least recently, 99.9% of the time, it's a canned speech that's written. In many cases, it's written exceptionally carefully, right? Because they don't want to roil financial markets. But I can tell you, some great days and some, phenomenal performance in my portfolio have happened on maybe that 0.01 day that something's come outside of somebody's mouth and markets have gone astray, right? Kind of like when Chairman Greenspan, this was a while ago, came out with that irrational exuberance, right? Markets got clobbered on that. And that particular day's trades put a down payment on a townhouse for little punk Steve that just graduated from finance school, right? So there are times that you want to pay attention to, those types of moves in marketplaces. You can click on the specs. So there's the news next week. So for those of you that have just been beamed back down to earth, welcome. We are humans. This was a week of Thanksgiving, and it was basically a slow holiday week. We were closed down for a couple days, or actually a few days. So anyways, next week, our first full week back. It's also the last week of November. It's the first week of December. Typically, what happens in these periods of time is that markets rally, the dollar goes down, and all the other currencies go up, right? That's been the complete opposite case for most of this year. I would expect, unless there's some sort of bombshell in retail sales or, somebody's talking out of place in terms of interest rates, I would expect that to continue into next week. Albeit, I must admit, for those trading indexes, either manually or via AI on the MT4 platform, there has been an inordinate amount of conspiracy theories this weekend that there's going to be a huge correction coming up in equities. Wouldn't surprise me, but it's rare coming into the end of the year. And I'll tell you why. After October 30th, right? Let me just double check the count. I think this was October 31st. Yeah, so after October 31st, this is the last day for the majority, I'm saying probably 85% of the actively traded portfolios and indexes on this planet that have a fiscal year end of October 31st. So that means that, at least in my opinion, much of the juxtapositioning or window dressing, if you will, has already taken place, right? Now, what is different this year that hasn't been different in pretty much like every other year, the last 12 years, we've been rallying equities globally, right? In developed markets. We're down, right? So the big kink in this normal Santa Claus rally discussion, like normally if this was any other year of the previous 12, you'd hear something like this from me in December. Okay, so we're up, make up a number. Markets are up, 15, 16%. A lot of portfolio managers have outpaced the markets. They don't want to disrupt their year-end bonuses, right? So the status quo typically remains the same. And if there's no big down, what usually has a tendency to happen, and that's a market that just drifts up, right? It's always a tough market to short at the end of the year. It's always not a wise deal. But this year is different than the last 12 in that we have much higher interest rates. We have an equity market that's down, right? So if you're a portfolio manager, I really don't care what you're trading, right? For whatever type of outfit you're trading for, doesn't really matter. In many cases, especially if it's equity and bond land and a lot of other stuff that's pin action off that, you're down this year. And it isn't looking good for you. Even though everybody's, well, the market's down, we ride with them. Doesn't work that way. So a lot of these guys don't want to stain on their career. So what does that mean? That means there's a lot of unknown coming up over the next month. Will it be big down in effort to, will the markets just try and rip to not make these portfolios look so bad when the numbers get compiled December 31st, right? So there's a myriad of things that can take place that just brings, in my opinion, the potential for instability. Now, obviously, that's been the case for a while, right? But you have to look at this, and this becomes at least an exercise in risk management and looking at it from the perspective of something else, right? So I always tell people to step outside their box and take a look at the situation from an outside view. It's tough to do in some cases, but really good traders and portfolio managers around the globe, regardless of what they trade, they are experts at being able to see the from the inside out, right? And then see from the outside in, right? It's kind of like my favorite Zeppelin album, In Through the Outdoor, right? So the key really is that if I were a portfolio manager running a large mutual fund for Vanguard, Fidelity, right? T. Rowe Price, BlackRock, any of these guys, I'm basically hammering my team. We need to find some alpha, right? Alpha's outperformance beyond a particular benchmark. We need to find some alpha performance this year. What are we going to do? And everybody's hunting through it. It's like an episode of Billions, if you guys have ever seen it. It's actually a great series on Showtime that is now finished. But it's really good. Talks a lot about how they're just constantly hunting for alpha, right? And that's more of that hunter-gatherer hedge fund mentality, but it exists in regular equity funds as well. especially if it's an actively traded fund that's not indexed, actively managed, right? Seem to be a dying breed on Wall Street, but there are a lot of really good active equity funds that still continue to clobber the benchmark, even though that list is small, right? And if you're wondering what that list looks like, you can certainly send me an email as well, because we use some of these actively traded funds that have acted more hedge fund-like because they have a real hedge strategy inside how the portfolio operates. But if I'm this manager, he or she is going to be really putting pressure on their team to kind of get return, right? So notice we've walked down a long path, right? This is my weekend diatribe discussion, because now you probably have a better understanding of how risk works from the standpoint of people that are behind the game, right? And in many cases, people that are in danger or threatened, or they're climbing out of a huge loss, they become more volatile. It's just human nature, right? You've seen all the movies where these guys are throwing big bets down to Vegas because they've already blown up $1 million of their bucks, and now they're just betting big trying to get it back, which is a dangerous path to be on, right? Had you not lost that much money, you wouldn't be forced to take big bets, right? So that's why I always advocate don't have all your eggs in one basket. And by the way, for what it's worth, this is a bit off subject here, but I know I'll probably forget to talk about it. In crypto land, I got to tell you, I've talked to an inordinate amount of people that have a lot of crypto sitting in cold storage, guys. And I tell you, I just, if it's more than 20 or 30% of your wealth, I would not have that be the case, because I could foresee a time where you could not convert that cold storage crypto or whatever, man. It may be sitting in, some US dollar denominated, but if it's not sitting in what I call hard currency or gold, right? What if the whole system just blew up and you couldn't convert it back? Whatever's sitting in storage, it's essentially lost, at least for now, right? Now, it's kind of an Armageddon scenario, but I talked to a gentleman the other day. He's a pretty big builder at Auvoria. The guy's got a ton of money sitting in cold storage. I just don't agree. Period. I told him that. And, it's like a lot of these people have just been absolutely completely sold the idea of that conventional financial system is a teetering deck or house of cards. I don't agree. And even if you took the most Armageddon scenario, which we basically faced in the latter stages of 2008, the U.S. Treasury and many central banks took steps to mitigate. Yes, there was a lot of leverage. I just don't see it happening. I really don't. In a worst case scenario, right? And this is not investment advice, but this is what some of the smartest people do. I don't care if they have 100 grand or 100 million. They have a small percentage sitting in cash in a safe in gold, not the big fat gold bars like you see in these videos. That's not a monetizable thing in a ending of the world scenario, right? A small gold bars and or cash in a big ass safe. That's what I have. That's what a lot of people have. So if you're truly at the end of the world scenario, that cold storage is going to do shit for you. So just as a heads up, all those out there saying that, you're bragging about this or that digital device that's holding your stuff. What if you can't convert it back to usable cash to buy food or medicine? That's a problem. That's risk. So I don't have it. I don't own any cold storage. I have, plenty of preparation, including a buddy, believe it or not, outside of Vegas that we could live off the grid for months. That, I certainly could just jet back over there if things are falling apart. But outside of my half-assed end of the world strategy, I have I keep a very small amount in a liquid base, right? So let's just say that. So I don't know how many people this affects. I'd probably be shocked to understand some of the numbers, but this just falls in line with like a complete, collapse in that kind of system, right? And if you're like, well, it can't happen, it's happened before, right? There was all kinds of monetary systems in, and I know a lot of people can be like, well, that was the 1800s. But there was plenty of systems between the 14 and 1800s that completely collapsed, that they said were uncollapsible, right? Just because when risk is taken off the table fast, and let's say there's a domino effect of organizations that go down because of this SBX crap, it could be a domino effect. And then the question you got to ask yourself is, I've locked all this money up in X, Y, and Z. Is it liquid? Rest of the news next week. CPI. This is the Canadian CPI, but still think it's important. Take a look at it. Anything that's CPI or PPI obviously is the top precedent. And yes, even though next week is non-farm payroll, you want to look to see what the unemployment rate is, see if they beat the 200K. This could have, I don't know, a small pin action effect on how the Federal Reserve acts. Still think it's based on inflation. On the inflation front, surprisingly enough, a CBS news site, these guys are a crap news organization, but they had a very good broken down of what is a dovish versus hawkish policy. So you guys can read it or whatever, but essentially a dovish policy or policymaker, right, central banker, will attempt to encourage rather than restrain economic growth. This is done by means of looser monetary policy. So if you're wondering what did the last 12 years before this year look like, it was right here. And now we're hawkish, okay? And policymakers tend to be mostly concerned about the risk of inflation, so they try to keep a lid on rising prices by increasing interest rates, reducing the supply of money. What does this mean? This means that they're bringing in denominations. They are affecting both M1 through M3 money supply in the form of repurchasing, right? Remember, I used that example of all the children sitting in a circle with a bunch of apples, right? Now, all the children are putting all their apples in the circle for sale. And that's creating pricing issues, and obviously the price of the bond market, which is the largest on the planet, in terms of credit, not as large as Forex, but it is very large in terms of total amount of denomination, second largest of all markets. But the U.S. is the largest in terms of credit of all markets from a bond perspective. The price of those have gone way down, obviously, because of what I've talked about, right? Too much supply hitting the market, price goes down, thus yield has increased, and the cost of capital and all of this has just gone up dramatically, right? Even though many will this is usually folks either in real estate or the automotive industry, will say, well, like rates are still favorable on this car loan. It's 399, and I saw an ad the other day, Audi's offering 399 money, which, they've done for the last 12 years. Yes, that's correct. So the dealership, or in this case, the finance company backing them, or for that matter, Audi Finance, is the one taking the hit. It's what's called a loss leader in order to get the business in the door, right? So essentially, hawkish versus dovish. That is it for the news. Let's go into the charts. Didn't talk too much about that. This is S&P single day. So low, and this actually, you know what? I'm going to use the spiders. I'm just going to use the index as a whole. Spiders is the proxy ETF for the index. I like this because it's like the whole shebang, as you guys know, I like to look at everything on a large screen. The bottom of this was essentially 3,500. This is just an absolute floor for a whole host of reasons. I'm not going to scroll back to further lows. This was, basically it. So it's a pretty pivotal day. And this, ever since this period of time, which was essentially the 13th of October, this whole lift has been because of pivot. They think now that there's smaller inflation, that the Fed's going to pivot and pause, right? I could tell you if in fact they did do that in December, markets would probably rocket up into the end of the year. And then we get some higher inflation numbers come out again. This is going right back down. Probably will crash through the low of this. So I always, and I certainly have said, if you take a look at the volumes on this, and look, I get it, a lot of this is holiday volume, right? But just in general, when markets are lifting, you want to see lots of participation, not declining volume, right? So the market's volume has declined all the way into, Friday the 25th, yesterday, which is really kind of like a half day of trading. Low volumes, if really anything to measure, it's not worth it. But, the market's betting on something that may not be the case. Every time that's happened, you can see the damage that gets done real quickly. So, the rally, stair step up, had a bit of a sideways trade, was an absolute elevator down and blew through in 3 days what took months to build, right? So for those of you trading any kind of equity index or equities or ETFs or funds or any of that stuff, just know that is sort of my prognostication, but I could be wrong, and everything could be much different than that just based on the simple fact that if inflation keeps dropping a bunch, the Fed's kind of done their job, right? 2 months don't make a data set, but it's a start, right? I just don't know. That's the problem. And then the other issue is not to make your head spin around with more stuff, but if inflation starts dropping like an absolute rock, that's going to wind up being deflationary. Guess what? That's just as bearish. So that means that they have no pricing pressure and earnings start falling to the floor. So it's the opposite effect. Steve, we can't win. It's either one or the other. Well, no. We won for 12 years with an accommodative central bank globally, right? But the music has stopped. You know what? I never Googled my email address. Let's see. I tell you guys should have why is that not? Tell you what, hang on 1 second. Let me grab my phone. I gotta double check this. All right. Back to the charts. So that's kind of where I feel on the S&P at this point. Let's take a look at just a quick NASDAQ. I don't like trading the Dow. That's why I don't show it. I do get complaints that I don't show it. So here's the Dow. It's actually done better than the S&P, but I think this is an inefficient benchmark, and I would never trade an ETF or an index or any futures contract on it. Just my opinion. Here's the Qs. This is as super liquid as spiders are. Not as rosy of a situation, obviously, because a lot of tech stocks have been just absolutely battered. NVIDIA, you guys know my feelings on that. Moving into the emerging markets. Actually, surprisingly enough, let's go back to the DAX. Look at this. I'm actually going to cut through this and just put into a weekly and then just take some noise out of this market. This is pretty impressive rally. Is Putin going to stop bombing Ukraine? Don't know. I could be wrong. I used to trade a little bit of DAX futures in the day. Since 14,720 area is big. Not only is it the previous range low, it is also a support and resistance point. It's probably a couple of fibs in here maybe like a 68 retrace. So what I'm looking at? No, high to low. It's a couple of forks that are lining up here as well. But if we clear this area and anything halfway near decent, I would imagine the center point is where we're headed next, wherever that would be. You'd have to just have this on the screen, removing all previous, just looking at the center point of this upper sideways trade and balance building area. And the center point's typically the next target. So just keep that in mind if you're trading this in any form. All right, so let's go to the dollar. Now, it's probably good I'm coming into this on a weekly chart. You guys to see how far we still have come, right? Bottom of the market here. Not normally have this kind of move up. If you're wondering historically how this all plays out, I don't think I've shown this chart in a while. Let's go to a monthly. Okay. Now I really only care about this entire upper area we've been in. Notice we were right near the bottom here. And, many were calling for us to break and hit this whole 85 area, which I still think could be visited again. But obviously the lesser of all evils, which I find surprising with the amount of debt we have, but that is in fact the case, is the place where much of this trade took place almost from and these are monthly charts, by the way. So been a big reversal off of, and a lot of that is just due to, maybe we overshot. Notice how many times, which is very rare as well, just look at how many times we blew through the upper Bollinger Bands. This is not normal on a chart. Let's see, the last time we did this was 8 years ago, right? Not normal to see how just outstretched volatility to the upside. Was it worth it? I don't know. I mean, it certainly overshot, but we had, just monumental resistance right here. We just blew through that. So it's tough from a long-term perspective how that all plays out. Let's drop back to a daily. Basically 108 on the upside. And then the big 200 here. See this red line? We've got, I'll just get down here. So these are single moving averages, by the way. So I chart 50, 100, and 200, but why am I not seeing? I can mess with that later. So we're coming up against the 200 days, a big one, especially on daily. 200 days, a big one on almost any time frame, including some of the smaller ones. Take a look at Euro US dollar. The opposite, typically, of what we saw. Again, 200 day. Notice this was totally containing this because we've come off a bunch. So I've lost my opportunity for parity, right? Dollar for dollar. Go to Europe, it's cheaper. On vacation, we're going to the Dominican Republic instead. But the movement above this area, I think, would be pretty contained from the perspective of here's the next zone. Probably going to hit, I don't know if you guys can see this right here, but there's a high point right here, right at 105, right in that 25, 101 spot 0525 area. If we're going to continue up, this would be my argument for a target. And it's the center point with a lot of trading volume of that whole upper zone that's above this one, right? You typically will run to the center. If there is no resistance, then you will run to the top of the previous zone or any other amalgamation of confluence points that are up there. It could be fib based, wave based, any kind of channel or stretch based, could be moving average based. It could be certainly market profile based. It's mostly where I'm pulling from here in that prognosis. And then on the downside would be probably this point of control. I don't know if you guys can see this here. So I have, what's the day to? Data from the 5th of May on the screen. So all volume since this whole move, it's a pretty broad move, obviously, but all data. So the center line, or the center point, essentially where most of the executions took place from a volume aggregation, a price, is right almost perfectly at a buck, which I think would be our support on the way down. The pound continuing to climb out of the hole that was nuttiness here on the 26th. Seems like just yesterday. Notice we're right at that point of control. We've got the same date, right? Yeah. So May, all till now, is included in all this data. You can see here's the center point. We're pausing right at it. So it is offering some resistance right here at 1.2085, 80 area, all the way up to the spot 2185 area. And then you've got the resistance from a squeeze zone. That's what these line colors are here. This is that's a 14-point calculation as to this, why these lines are essentially, they auto show up. Pretty accurate. Good stuff. Sign again. Hats off to the man for developing some of this stuff for TradingView. Love it. Always would base most of my support and resistance lines off of market profile charts. So it's good to have other factors that account for what is called a squeeze zone. Let's see, US dollar Canadian. Notice that point of control line way down here. Don't see that being an issue. Looks like we're probably just going to be continuing to trade the lower third of this zone here, high, low. Yen, not going to get into it. Unless I see anything crazy. Yes, these are still daily charts. Just ripping through this stuff. Notice how weak the Canadian is in this one, of note. Again, euro strength. It's been surprising. So the DAX, right? That's surprising against the pound. Only because the pound's been stronger. So GBP CAD, let me just look at the weekly here. Been good. Since 19, right? So we could bring just a little bit more data in. Coming up on a bunch of years now, volume. Here's the center line right here, 1.7090 area. Notice this is the bottom third of this zone. See that? That is a hard and fast. So if we could get past this 66 area, get past 67, 30-ish area, we're going to rip right to this zone. Don't see that happening just yet. Just you always want to know where your stuff is on the upside and downside of these trades. So in case you're manually trading or proving trades, at least you know where they're being placed at and hopefully for what reason. Spot gold still kind of hanging there. Let's jump back to a daily. Let's take a look at the cryptoness. Still hanging. There's a chart of just dailies. There's a lot of noise in this chart, guys. You certainly could argue to look at this from a weekly perspective, which is my more favorite chart in crypto land, especially for someone that's been trading a lot, right? I want to see all the volume since the run up, right? Here's the previous run up. If you don't like old data, you do want to see some of this trading, so you could certainly remove that and start off. There's the 9th of March of 20. These two big down candles on these weekly charts were because equity markets were getting absolutely clobbered at that point. But this is where the liftoff began. So you'd think that from a volume perspective, this red point of control line would be much higher, huh? It's not. You know, you can always play around with the data. You can include what or what not to have in there, right? But as you continue to just take smaller swaths or smaller views of the screen, the data changes from a volume aggregating perspective. So look at this right here. Yeah, there's some missing notches at 26. Very much an incomplete auction right here. Missing notches have a tendency to get filled, at least from an auctioning perspective. So let's drop back to just the last 6 months. Actually, this is way too noisy. Look at that. Let's just look at the last. Oof. It's like way too much noise showing up here. That's why I don't like these charts. You don't have to have this move in there, but I do think you want to have the screen brought back to just where I was before. See? And if you do that, it's putting us right at that target that I've outlined a couple of times. So this is a long-term point of control right at the 91.92. Now, if all of crypto's falling apart and nothing's sort of liquid and it's, none of these levels lower are really going to matter. So I wouldn't be dropping any knives down in any of this stuff. But I got to tell you, from the perspective of just pure technical analysis, the value of this, sort of that sifting through the ashes mentality I talk a lot about, this is starting to get interesting here, right? Doesn't mean I'm going to buy, right? It's a dangerous time to be purchasing, in my opinion. Could be wrong, right? But this is the time where you want to know that, hey, we've lost so much value. Now it's starting to get interesting from the perspective of what I call dipping a toe in the water, right? Just understand that if we use the fun and alligator stories of Florida, if you dip that little toe in the water right now, then alligator could still come and get it, right? But you're beginning to think like a long-term institutional trader. And that is my genuine hope, is that you think like that and you wind up being diversified throughout your life with hopefully millions of dollars in diversification across lots of stuff. And with that, we will end. It's 11 a.m. Eastern time. Everybody go have a great rest of the holiday weekend. I would highly suggest, if you have extra time, go through the last few weeks. I've given you the link. You can send me an email if you got any of the links to some of the stuff. And I will look forward to talking to you guys on Tuesday. May the trades be with you.